The broadcast is now starting. All attendees are in listen-only mode.
Good morning, I'm Ken Leon, Director of Equity Research at CFRA, and thank you for joining us today on Streaming TV Revolution, a golden but disruptive new era. Our presenters today are Tuna Omobi, Industry Analyst for Communication Services, and Angelo Zeno, our Industry Analyst for Information Technology. We're excited to really go through this presentation, given obviously all the issues and crisis from the coronavirus and people also looking, besides work from home, their entertainment is coming from home as well, from streaming. Moving to the next slide. CFRA has a great reputation as an independent research firm with over 90 years of innovation and growth. The firm today includes from the forensic accounting capabilities, along with in October 2016, CFRA acquired S&P Equity and Fund Research. More recently, we acquired FirstBridge Data, which gives us an enormous capability for ETF data. So today we're one of the largest independent research firms. Next. CFRA does blend these two powerful capabilities of equity and forensic accounting that enables us to leverage our research through a lot of the areas that you see on the left related to markets and strategy, market commentary, our sector and industry research, distilling it down to ETF and mutual funds, and also our coverage on company research, covering on a qualitative research base well over 1,500 global companies. We also do deep dives in terms of diagnostic industry and company monitoring for risk assessment or risk mitigation. As the novel coronavirus or COVID-19 brings uncertainty to the global economic and financial industry, CFRA analysts and strategists remain focused on delivering exceptional research insights to help investors stay up to date on the latest market developments during these turbulent times. Volatility has been a chief concern to investors in recent days, and CFRA's focus on risk mitigation makes our research valuable resource. In addition to the great thematic work we have been publishing around coronavirus, we do deliver market commentary, insights, and portfolio guidance. You can see here on slide art, we take our insights and quality to proven performance. Recent investors ranking shows CFRA #1 position for buy sells for 1 year and 3-month trailing averages for those firms covering over 900 stocks. And this was as of March 20th, 2020. So we are certainly driving the market in terms of our recommendations. And finally, CFRA's ETF and mutual fund research methodology on the next slide is forward-looking. It is a unique forward-looking ranking system, while other research and ranking systems are not. Through a machine learning model, we examine the underlying holdings of funds, pulling in fundamental research, forensic accounting, valuation, and risk metrics to determine the probability of outperformance versus the peers. And this includes our overall star rankings and other sub-industry scores on cost, risk, and reward. Now, rankings that only look backward at factors and data from decades plus our long bull market are likely not going to be as useful as forward-looking, in our opinion. Next, please. Ultimately, CFRA puts all of its resources into research. Many independent research providers claim to be free of conflicts. We are not. We are totally focused on fundamental independent research, and we feel this is a value for our customers to help them in their portfolios and asset management. Some of our competitors do not do this, and we feel putting all of our resources in these troubled times for research will help you. Moving on, so we're going to start the presentation. Let me turn it over to Tuna Moby to talk about streaming. Tuna, good morning.
Thank you so much, Ken, and good morning, everyone. We're very glad that you can join us today. As Ken alluded to, I will pick up the presentation and kind of give you a lot more insight about the streaming and OTT market. So here's the agenda of how I'm going to go through the next several slides. We'll kind of look at the streaming market evolution, also known as over the top. So when you hear OTT, pretty much refers to the online video streaming. And then we'll look at the secular drivers of OTT growth, some of those elements like pay TV cord cutting, and then the consumer behavior and demographics, which is a very important element in terms of how the streaming wars have kind of evolved. We'll also look at some of the economic considerations and factors that investors ought to be paying attention to as you kind of assess these streaming platforms and their parent companies and some of the projections out there. And then we'll kind of, last but not the least, look at some of the potential winners and losers as we kind of try to get a better handle of this early trends and some of the key players and what we see out there. So kind of moving on from there, this slide is how we kind of picture the current battlefront for the streaming. You hear about the streaming wars. Some people kind of think of these streaming wars as one gigantic battle out there. What we've done is kind of step back and take a look at all of the trends out there and kind of try to figure out how this battle is playing out. And what we've found is that the rather than one gigantic battle out there, the war is actually playing out on several fronts. So we've kind of taken a compartmentalized approach to looking at this streaming wars playing out on various battle fronts. So the first block there is a subscription video on demand, also referred to as SVOD. So when you hear SVOD, that's the subscription model where you have some of the key players like Netflix, Amazon, etc. And then we're expecting an imminent entrant in HBO Max in May. The middle block is referred to virtual multi-channel video programming distributors, also known as digital MVPDs. Now, these are smaller sized packages that tend to include live programming that kind of try to replicate the live broadcast as opposed to the on-demand model. You've got Hulu and Sling and other players that are actively exploring this. This is the block that you've heard about, skinny bundles. And then the third block here is the ad-supported video on demand model, where you've got several notable players as well, including Pluto TV, Roku channel, Facebook Watch, etc. Now, the key entrant in this segment is the Peacock, expected by next month. Actually, this month now, we're in April, owned by Comcast. The two other segments where we see the battlefront playing out, the streaming media players on the left side, notably including Roku and Apple TV, Amazon. And then lastly, sports programming content, where you've got ESPN Plus and others. So the reason we've adopted this differentiated this is the essence of our differentiated approach. The reason we've taken this is that we see the battle playing out across several fronts. We see some companies playing in multiple categories with the potential to win in some categories and maybe not win in others. Remember, this is still an early evolving trend, and we see this battle playing out on multiple fronts. So moving right ahead here, I know COVID-19 has been top of mind for a lot of folks, so we figured we kind of take a step back and see how this COVID-19 is impacting the streaming OTT landscape. we see a number of potential positive implications as well as potential negative implications. First one is the spike in OTT viewing hours, which is really no surprise here, because a lot of folks are staying home and trying to get up to speed with the news, all the quarantines and social distancing, binge viewing accelerating and proliferating as a result of more in-home and telecommuting hours. We see potential benefits for cheaper SVOD services or even free AVOD services due to increased cord cutting. And by the way, cord cutting is really dropping your traditional pay TV subscriptions because, for example, they might be more expensive in this economic times or high unemployment for a variety of reasons. Advertising shift from linear to digital could also occur as a potential positive as advertisers look to shift some of their budgetary allocations to digital platforms due to perhaps the potential recession in traditional advertising demand. Now, there's negative implications I might also point out as a result of this COVID-19. We see, likes of Netflix and other platforms having a surge in volumes. Now, Netflix and others have to pay for content delivery technology costs, so-called content delivery networks. And these costs are a function of the volumes that we see, the pressure on all these servers. Now, there's also a potential negative vulnerability to economic recession. These high unemployment reports could make more people to cut OTT offerings, and advertising demand as well could be impacted for AVOD services. The sports-focused OTT platforms, we know that likes of ESPN and others will be adversely impacted by the mass cancellation of sports, broadcasts across all the major sports, whether it's professional, college sports, etc. And then the bandwidth congestion and outage due to the surge in volumes could impact the audio and video quality. So this is how we see some of the potential positives and negatives from the COVID-19 situation for the purposes of this analysis. Now, here's the what we can identify as the main players within this streaming space. These are the so-called incumbents, the big four, including Amazon, Netflix, YouTube, and Hulu, right? These are like early movers. They tend to right now command the time spent streaming OTT, as well as the penetration of OTT households. As a matter of fact, even as we talk about the upsurge in viewing during this COVID-19, these four are garnering the lion's share, more than 2/3 of the increase in streaming minutes during this COVID-19. Now, what has happened is that these four are facing intensifying competition, as you'll soon see from a host of other players. So this landscape is about to get, or is getting more crowded. So the share of these four in terms of time spent streaming and penetration will be shifting quite remarkably as we kind of look at the intensifying streaming wars. Moving on to this slide, this is some of the newest, latest announcements from some of the high-profile companies that have recently jumped into this OTT landscape. You'll see parent companies on the left column, which is kind of a who is who of some of the major internet and media companies out there, all looking to get a piece of this pie. I might also add that, over the next couple of months, we'll see new entrants in HBO Max and also House of Brands and Peacock, all owned by some of the major media companies. Moving on to this slide 15. And I might also go on slide 16. You can think of these two slides as reference slides that will kind of see list most of the major players out there as we see them, their parent companies, their genres, etc. You can take a look at these two slides and it'll kind of give you a list of how the last decade, going back to the launch of Netflix in 2007 up until the latest dates, most likely going to see a continued increase in this list based on the new entrants that we're seeing. And then moving on to this slide here, I think this is quite a remarkable slide. It gives you a picture of how the OTT players stack up against the traditional pay TV providers. So this slide kind of aggregates the streamers with the legacy pay TV providers. And I think what's remarkable here, if you look at the top three providers here in terms of the number of subscribers. The streaming platforms actually now have vaulted into the top 3 in terms of the number of subscribers, displacing some of the legacy companies like Comcast and Charter, etc. And if you look at the list more closely, you'll see that out of the top 10 video providers as of the end of last year in terms of number of subscribers, OTT platforms actually account for 6 of the top 10. Now, this is very remarkable if you think about the fact that the OTT didn't even exist. I think Netflix actually launched their streaming in early 2007. So it tells you how this category has come so fast, has grown so fast, and how long that they have come in trying to challenge the incumbent legacy TV providers. Now, moving on to here is an advertising-supported video on demand, also known as AVOD. Again, another reference slide for you to see how this category has been evolving, the potential launches, and who are some of the main players. AVOD are those free ad-supported platforms that provide programming and tend to rely on generating digital advertising to support their business models, as opposed to the SVOD that we kind of looked at before. The next section of this presentation, I will discuss the secular drivers of OTT growth, which I kind of think is very important to give you a perspective of how this streaming phenomenon has the underlying drivers that are kind of driving the catalyst that we see the shift over. This is not something that just happened overnight. It's been some trends that we identified over the last decade that have been really driving this OTT streaming evolution. The first one I want to highlight here, the first secular trend, the traditional pay TV video market has been in a secular decline. If you look at the top, the major traditional pay TV providers in cable, satellite, and telco, going back to 2013, the trend has been going down. Really no surprise there, because I think you've heard about cord cutting, which is folks dropping their traditional pay TV subscriptions and looking for cheaper online alternatives. So that trend has been going on and is projected to continue, the attrition in pay TV subscribers across all the major categories. Now, the other trend here that I'd like to mention in the passing, not really shown on this chart, related to this, is that the viewership of traditional television in terms of television ratings on linear networks, whether it's broadcast or cable, have also been in a secular decline. And one of the main reasons for that is that viewers are migrating to cheap online video and streaming platforms. As a result, we're also seeing declining viewership of television and also declining subscribers. Now, this slide here gives you a picture of the left side of the chart of why people are dropping their pay TV services. Really no surprise at the top of that list is that consumers think that the cost of pay TV service is too high. So you see that top bar there, and that's been pretty much consistently the top reason why people opt out of traditional pay TV and switch to the cheaper OTT platforms. On the right side of that slide, you'll see the average number of SVOD subscriptions among cord cutter households and cord never households. And by the way, cord never households by definition are those households who grown up, those consumers have never subscribed to legacy pay TV services. And cord cutters are those that are cutting out their those services for one reason or the other. And you'll see that both cord cutters and cord nevers, the number of average SVOD subscriptions have been rising over the last few years, and that trend is expected to continue. The next slide here gives us the composition and profile of OTT viewers. I think a takeaway here is that most OTT viewers are still pay TV subscribers who now account for less than 50% of OTT viewing hours. So I think the important thing to remember in this chart is that some people might have the idea that subscribing to OTTs necessarily means that you're not a pay TV subscriber. I think this chart clearly shows that both in terms of the share of OTT households, in terms of share of OTT viewing hours, that pay TV subscribers continue to command a very dominant or a fairly significant a portion, even as the percent of cord nevers continue to increase. These pay TV homes, quite a number of them continue to be OTT subscribers. So I think this is the essence of our thesis that, you know, OTT is not necessarily a zero-sum game. There's indeed complementary subscriptions across both OTT and traditional platforms. The next slide here is really a depiction of number of OTT SVOD subscribers and penetration on the left, as well as the average number of subscriptions on the right across all U.S. homes. So you get a sense here on the left side that the subscribers and penetration both have been trending up the last several years, now almost at over 70%. And the average number across all homes also has been going up. So in fact, multiple homes have either a combination of Netflix, Hulu, Amazon, etc. People are really picking and choosing these platforms as to suit their preferences. And then moving on, this is a chart showing the broadband homes, which we feel has also been a major catalyst in terms of the OTT growth. Now, broadband homes, by definition, are subscribers, or those homes that subscribe to wireline high-speed internet service. Wireline meaning either cable broadband or fiber-based broadband from the telcos. Those homes are subscribed to just those services without subscribing to legacy video services. So think about, homes just purchase high-speed broadband subscriptions just for the sake of streaming. Now, the number of those broadband-only homes, according to this chart, has been going up, both in terms of the number and the penetration of broadband homes. Now, this is a very important trend to keep in mind as you think about the younger audiences, the millennials and the Gen Z, who just, have internet subscriptions and they use that to just stream. So this is a trend, matter of fact, that just started a few years ago, not too long ago, and we've seen that number continuing to increase and account for why a lot of people are switching out of traditional pay TV. This chart, the next section of this presentation, will kind of look at some of the consumer behavior and demographic trends, which I think is very important to understand the underlying trends in the OTT evolution, which again, there's been quite some remarkable changes in both behavior and demographics that can put some proper context on some of the trends. Now, internet connectivity, it has been fueling the streaming boom. If you look at the left side of this chart, in terms of the total US households that stream OTT content, you'll see that now almost 2/3 have been streaming across all OTT devices, with streaming box and sticks and smart TV and gaming consoles among some of the popular categories. On the right side of that chart tells you the methods that are used to view online video on household television. And if you take a look at that list, you'll see that quite a number of a number of methods are being used. Internet-enabled smart TVs and streaming media, player sticks, etc. So you kind of get a sense over time that more and more households are using a variety of methods to view online video on their household television. So that's really important here. Some of the and then moving on to the next slide here, binge watching and content preferences. Left side of that chart, some of you might have heard binge watching. This is a relatively new phenomenon. And while binge watching has no universal definition for this purpose, we'll define it as watching 2 or more consecutive episodes of a show at least once a week. So this is something that is a very important trend as we see a new normal, even more so in these times of COVID-19. If you remember when I put up the COVID-19 slide, so it's taking on a new meaning. As more and more people, whether it's staying up all night to watch a show or or watching a new season of a series within 24 hours, canceling social plans, things of that nature. You get a sense that this is something that is taking hold. On the right side of that chart, you look at Netflix and Prime Video, Amazon and Hulu and HBO Now, kind of gives you an idea of the type of content that binge watchers, that users prefer to watch the most. No surprise, original TV shows and recent movies, etc., things of that nature, all accounting for why people are more and more binge watching. And also this is something helping to explain why we're seeing such a surge in content viewing as well as content investments. Next slide here gives you a sense of the streaming media players' ownership trends by model. The numbers in this table represent percent of internet adults, So all of these are the major streaming media players. You'll see a higher penetration of streaming media players among Roku, Amazon, Apple TV, and Google in terms of the percent penetration of internet adults. So you get a sense as to how the S&P streaming media player is kind of dominated and concentrated. If you remember this slide I put up earlier in the evolution of the battlefronts, these are some of the key players within that space. And then the demographic perspective on this slide is important to understand the trends. On the left side, you'll see in terms of weekly hours how the various demographic groups are playing in terms of viewership for both linear and OTT. The takeaway here is that the OTT, the younger audience tends to skew more on the OTT side here. You see the matures or the seniors tend to view more of the linear broadcast TV. The right side shows the OTT viewership segmentation by key demos. Again, here, no surprise that in terms of the cord cutters and cord nevers tend to skew toward more of the younger demographics, and vice versa for the pay TV subscribers. So just kind of moving on here to mobile viewership. Again, this chart tells a story of how younger audiences are driving out-of-home mobile viewing in terms of the frequency of mobile viewing or no mobile viewing at all. So you'll get a sense here, the millennials and Gen Z and Gen X, the younger ones are viewing more frequent mobile viewers out of home compared to the boomers and the seniors. Again, very important, underscores how younger demographics are driving some of the OTT trends and catalysts that we've been talking about. Now, here is another kind of perspective on the demographics, you know, how here in terms of household income segmentation. I think the takeaway in these two charts is that cordless viewers skew to lower income households. So look at the left chart there, cordless viewers as a percent of household income segment. You'll see how that's concentrated more in terms of the lower income ladder. On the right side shows the universe segmentation by household income. Again, the story is consistent there in terms of the concentration of the lower income for the OTT and skewing more on the higher income for the traditional pay TV. So this is an important trend, which ties back, if you remember the earlier slide I put up as to the main reason why people drop legacy TV services is the cost being viewed as kind of too high. So demographics really an important part of the secular trends there. Next section of this presentation, I wanted to highlight some of the economic factors and considerations which are important to keep in mind as you kind of look at the OTT landscape. Some things that investors also tend to focus quite a bit because remember, this is still a new category, still evolving, still a lot of moving parts. So just the next slide here, I think sets the context quite nicely. Over the last several years, and in fact decades, I think we've seen the number of scripted original series on television and streaming platforms explode. Now, it wasn't really until maybe 8-9 years ago that number started to increase systematically. Really no surprise, coincident with the evolution of the streaming platforms. So you look at the composition of the number, see the online services accounting for a big part of why you're seeing the number of scripted shows continuing to increase. On the right side, you look at that same data point up until 2019, the CAGR of 6.5% over the period in question. That trend, again, being explained by the advent of OTT platforms who are investing so heavily on original and scripted series on their platforms, whether it's Netflix, Amazon, or etc. Everyone is really kind of upped their programming investment in terms of the number of shows. The next slide here is a look at the streaming programming costs, which is a direct result of the increase in the number of shows that we just saw. The left side shows Netflix, Amazon, Hulu, Disney, and Apple, all notable names, and all of them ratcheting up their investments in streaming programming costs, helping to intensify the streaming wars, and that number projected to continue to increase over the next few years as the streaming war intensifies. The right side, Netflix, Amazon, and Hulu, again, another perspective on their on the streaming programming costs for these three incumbents. You'll see that number going back to 2014 has been going up across the board. Again, everyone is trying to get a piece of this viewership trends and ratcheting up their investments as we see more and more clutter. Everyone is trying to stand out with their programming investments. Now, the next slide here shows the base pricing for selected SVOD services. I think what's remarkable here is not only the range of prices that we see here at the top of HBO Max, going down at $14.99, and with Netflix somewhere in between there. And then at the bottom, you've got services priced as low as $2.99. So, and Apple TV, I might add, coming out of $4.99 towards the bottom. So everyone is really trying to intensify this battle and try to undercut the incumbents, as we see. And that's why I think the business model is going to get even more cutthroat as more and more deep-pocketed companies jump into the fray at prices that seem quite aggressive. And this is one of the things that we'll talk about pretty soon as we kind of look at some of the critical success factors. Here's a projection on this slide of the online video revenues for both SVOD and AVOD. I think you get a sense here that, this is a pretty attractive category projected to grow at a 16% CAGR over the next several years. This speaks to, again, a potentially attractive addressable market and why a lot of these companies are trying to get some piece of this pie, as explained by some of the programming investments. So it's definitely something that's still in the early stages of evolution and projected to continue to grow. Now, the next slide here shows you another perspective of how SVOD compares to electronic sell-through, which is really the services like Apple iTunes that allow you to pay for download and then the rentals. So different business models here, and you see SVOD again accounting for the dominant growth category. So which again explains why the SVOD platform has been among the most popular in terms of the business models for the OTT players. Next slide here. Next section, actually the last section of my presentation, I'll highlight some of the trends that we see that could impact the potential winners and losers within the OTT space. I think what to keep in mind here is that we're still in the very early innings of this war, and some of the players that we'll highlight in this section actually haven't launched yet. Some have launched, but just barely a few months old. So we'll just talk about how we see the factors that could determine potential winners and losers. Before we do that, I think it's important to show that the OTT space is actually a very brutal space. The landscape is littered with quite a number of companies that have shut down over the last several years, this list includes some notable names, some you might not have heard of. What's pretty clear to us here is that the recent shutdowns we've seen point to an inevitable shakeout in a very highly fragmented landscape, and you can be sure that this list will only get longer. Now, the critical success factors that we highlight here, the pricing and the business model has to be right with attractive price points in the business model. These are conscious decisions that companies have to make. Content offerings, one of the most important in terms of the quality and the breadth and the depth of content that you offer. It's very crucial as a success factor. And then the user interface and algorithms have to be very, very compelling, whether it's the search and navigation and discovery, or the personalization and recommendations. Those are all critical factors that create user engagement and help people to subscribe or stay on for whatever the business model is. The next set of success factors are that the supported devices has to be ubiquitous. So it's very important to be accessible across all platforms. The technical features and the video and audio quality, very important, including offline viewing, which allows you to actually download to go, which Netflix and Amazon just added those features not too long ago. And then supporting simultaneous streams. International rollout is also very important in terms of not just success in the US, but we know that the truly global, truly successful platforms need to have a global reach so that they can scale their content offerings and be able to tap into a lot of under-penetrated international markets, of which payment systems and infrastructure are very important considerations. Now, I also wanted to highlight a few names that bear watching out for as we kind of continue to evolve these trends. Walt Disney Company, which has a trifecta of offerings in Disney Plus, Hulu, and ESPN Plus. Disney is definitely one of the major players to watch. Having launched at Disney Plus in November to huge success, we know that Disney has been really planning for this. They offer all three services now as part of a bundle. They're playing in multiple categories and battlefronts, of which ESPN, a major player in sports, and in Hulu. So really complementary business models and genres here. Netflix being an early mover as well, already fully globally deployed, except in China. And we know Netflix has been spending heavily and having really a mix of original and licensed content is something that we think will definitely keep them in the game for quite some time. There's a lot of people talking about Netflix killers. I don't really view it that way. I think that Netflix will remain a viable competitor, even as their share might be impacted by the entry of these higher profile companies. And then you've got Amazon Prime Video, which again is a company that's been around for some time. The Prime Video is part of the Prime subscriptions. Amazon is able to fund their content investments, and they're able to also tie that into their IMDb platform at no extra cost. So this company really brings a lot of other features that some of the other players don't have, of which Prime membership perk for the Amazon Prime Video is actually a key part of that offering. AT&T Warner Media with HBO Max to launch. We know AT&T and Warner Media have some really attractive brands that they are trying to tap into and bundle with the HBO Max coming up. So this is definitely an important player to watch. And then Viacom, CBS House of Brands, which Viacom just merged in December with CBS, and they've unveiled a OTT strategy that will try to aggregate all of their brands together as one offering. We know CBS All Access is out there already. Pluto TV, which is an advertising supported platform. I think CBS is really, Viacom CBS, really looking to reinvent their streaming strategy to enable them to compete better with some of these bigger and more established players. And then lastly, but not the least, you've got Comcast, NBCU, which the Peacock is expected to launch this month, which is expected to be the cornerstone of their streamlined direct-to-consumer strategy. So Comcast, definitely by virtue of being there, a major conglomerate and their huge resources, definitely one to keep an eye on. And at this point, I wanted to pass on the presentation to Angelo Zeno, my colleague, who will talk about Apple TV, certainly another key player to watch as this streaming battle continues to evolve. Angelo?
Great, thanks a lot, Tuna. So, to Tuna's point, I'll spend the next few minutes talking about our outlook on Apple TV Plus, their streaming service. And as Tuna alluded to, Apple is a new player in the market, but we do believe they do have the potential to really be a dark horse in this space. And I'll highlight, why we think that here in the next couple of slides. So, first, I think it's important to look at Apple from a very high level. As you could all imagine, Apple's still very much an iPhone story, as they generate more than half their sales from that business. The story for Apple, though, is definitely shifting away from their core, iPhone, iPad, Mac businesses that really has driven the company over the past decade towards more of a services and wearables-oriented company. And services really the true key for Apple, because not only is it focused on more high-margin, recurring-based offerings, but more importantly, it creates a lot of stickiness to their ecosystem. And while services were only about 19%, or we project will be only about 19% of sales this year, from a profitability perspective, we estimate it's going to represent about 30% of the total. And really, given kind of the growth potential of this segment, we do believe this business should be valued, somewhere approaching $400 billion today. So, as we kind of drill down now into the services segment, this is where we estimate Apple generates its revenue. Apple doesn't actually release these numbers, but we estimate that about a third of their services revenue comes from the App Store. And, we believe the App Store revenue is absolutely substantial, a great business for them. But a lot of that revenue is really based on daily usage from the consumer. And the knock on this business is that it's not as stable as one may think. And we'll see, growth start to significantly decelerate as the iPhone installed base starts to level out. So for that reason, Apple's greater focus going forward within services appears to be more on subscriptions, which provides a lot better visibility and has had a lot more stickiness. The ones many of us use today include the likes of the iCloud and Apple Music. License is also a great business and includes agreements with the likes of Google, which helps Apple pays money to be which they pay Apple to pay money to be the default search engine on the platform. There you go. So what does the service look like? Relatively new service, as we highlighted, launched back in early November, and it launched at a price point of $4.99. But most people aren't paying for anything for the service that essentially is being given away in the first year with any purchase of an Apple hardware device. Lots of ways you can access the service. Of course, you can get it on an Apple device, but the company last year really began expanding the ability to use its services on many select third-party devices. Think about Samsung TVs, Roku's, your Fire TVs. This is also, a very big change to how Apple used to look at its business, where historically you can only use its service on its Apple device. But that kind of tells you again how they're really trying to shift the focus away from hardware and into services. In terms of content, very limited, and the reason they have to price so low in the market. About 24 original content at the moment, but up from about a half dozen at the time of launch. We believe Apple, though, has a goal of producing about 6 to 12 unique movies annually. What's different with Apple is, unlike Netflix, Apple isn't focused on binge watching, where it releases all the episodes of a season at once. In most cases, they'll drop an episode per week, or at most maybe 2 episodes periodically. And then finally, while Apple doesn't have the library of content like others, they do a great job of being able to provide a central spot to really merge other third-party content. Essentially, think of Apple as being kind of the new pipeline provider for many cord cutters out there, where historically it's a job that was done by the cable or the telecom and the cable providers that are out there. Next slide here. So how does Apple stack up against its competition? We really think there's 4 areas where they hold an advantage. First, it's essentially free at the moment. Price point can't really get any lower. In fact, we believe Apple will have the fastest adoption curve in terms of streaming after year 1. Think about over 240 million Apple devices kind of being sold in the span of a year. So the bigger question, as we all know, is what the true take rate of that streaming service, essentially what percentage of consumers we actually hold onto that service after the first year. That second advantage, that ecosystem, really can't be underestimated. $1.5 billion plus devices installed base, but more important, that iPhone customer base approaching 1 billion users. They have been plenty successful leveraging this installed base on the hardware side. Think of wearables like the Apple Watch, AirPods most recently, and with services like Apple Music. Third competitive advantage on our end is that customer base, most loyal customer base out there, with retention rates over 90% on the hardware side, also perceived as much more affluent and willing to spend on new services. And then finally, the fourth advantage, best capitalized company on the planet, net cash position of $99 billion, $207 billion cash on hand, generating over $50 billion plus in free cash flow annually. There's going to be a huge advantage over the next couple of years as they start to more aggressively spend on content. And really that CapEx trajectory, while it looks low relative to the likes of Netflix, which is spending over $15 billion a year, that Apple's number is going to go up exponentially, we expect, over the next couple of years. In terms of disadvantages, we already highlighted, there's only one, but it's a huge doozy, right? It's the lack of content on the ecosystem. Content, of course, the lifeblood for any successful streaming service. And if Apple doesn't get up to speed quickly, then it likely fails. At this point, they plan on doing it alone. But if they do, it's going to take a long time for that service to really become formidable with other services out there. But their other option will be to look for a major deal or a slew of smaller deals to help bolster that service real quick, which we think is actually a real possibility if they want to be serious about all this. On the next slide here, we believe the keys to success for Apple will be bundling its Apple TV streaming service and leveraging the ecosystem as much as possible. Starting with the latter, we estimate, again, about 200 million users will test out the streaming service in the first year, and even if we assume a take pay of less than 10%, we think the TV streaming service will be deemed a success after the first year. But Apple will need to really roll out a slew of new streaming content in the second half of this year if it wants to hold on to some of these subscribers, which we believe they will. Now, the success of Apple Music really shows you the potential opportunity of streaming. Most people were negative on Apple Music when it originally rolled out, saying Apple was too late to the game. But that's been far from the truth. Looking back 4 years later, the advantage for Apple Music, though, was its library, which really stacked up very close to its larger player, which is Spotify. On the TV streaming side of things, they're going to need to be creative because the library and content just is not there. And for that reason, the bundling strategy will be very important to keep an eye on. It's currently focused on bundling the service with the hardware side of things. But after the first year, we expect kind of that strategy to change course. We think the most likely scenario is that they lump the streaming service with music for $9.99 a month for those willing to stay on after a year. In addition, that could also help subscribers that are currently at Spotify, like me, finally jump to Apple Music, and I would be getting essentially the same music service with free content TV. I think second, but less likely scenario is bundling as a bundling strategy that will combine Apple TV streaming with competing offers. So, let the consumer pick several services on its channels feature, like HBO Now, and then lump it with Apple TV for a discounted price. And then just one other note on the bigger picture services concept for Apple. We think ultimately Apple looks to shift consumers towards more of an Amazon Prime business model. So you would pay a monthly price of, let's say, anywhere $20 to $30 for access to all of Apple's services like music, TV, the iCloud, Apple Care, gaming, their News Plus offerings, as well as other offerings, all in a kind of lump sum one offering. And to us, that's really the long-term vision and the holy grail for Apple's services business. Now, kind of going here to the last slide, where does Apple service go from here, and what role does Apple TV streaming have? So the services segment has more than doubled here over the last 4 years. And while we see essentially a sharp deceleration in growth, and that's mainly reflects the law of numbers, we think it's going to be able to sustain growth of at least 10 to 15% annually through 2023. And at that point, services will combine, we think, for over services along with while services will be over 40% of the profits, while services and wearables combined, we think will tilt to well over 50% of profits, which we think is an important inflection in how investors really value Apple. Now, in terms of the TV streaming side of things, it's a big assumption, but we think has the potential to be a $10 billion plus business by 2023 if Apple gets the content story right and takes the proper strategy of bundling the services with others. But at the end of the day, Apple's got the potential to really leverage the free cash flow generation of their core legacy hardware sales and invest it into kind of these new services and opportunities. And because of that, we're fairly bullish on the opportunity that's yet ahead for Apple and TV streaming. So with that, I'll just kind of pass it back on to Ken, and we'll head over for Q&A.
Thanks, Angelo and Tuna, for just great insights on a very exciting industry, streaming. In rapid fire, since we do have 5 minutes or so left, Tuna, lots of players in terms of OTT. How much consolidation do you expect over the horizon?
Thanks, Ken. I think it's pretty clear that it's a very fragmented landscape, which leads us to believe that we're going to see kind of a shakeout or consolidation. Now, whether that's in the next 5 years or 10 years or 3 years remains to be seen. But even as we speak, we know that there's been reports of some of the major players, major conglomerates like Comcast, reportedly in talks to acquire Vudu, which is Walmart's streaming service, and also Fox, reportedly in talks to acquire Tubi, which is another ad-supported platform. And by the way, these two potential targets were listed on that slide I had on the AVOD players. So we expect these kind of trends to continue. Just early last year, Viacom acquired Pluto TV. So the determinants or drivers for this consolidation, companies looking to expand into other business models or to diversify their offerings across genres, etc. So certainly something that we expect to see continue to over the next several years.
And Tuna, we saw Hulu and Disney Plus. How are they related, or where's the direction for both? Disney and Hulu, Disney Plus are part of Disney, right? Disney got control of Hulu when they acquired the Fox acquisition last year. Disney's offering ESPN Plus, Disney Plus, and Hulu as part of a trifecta bundle for $12.99 a month, which is another strategy for them to kind of broaden their offering and reach out to demographics or consumers that otherwise they may not be able to reach. Angelo, Apple is just an enormous player in the market, and they were successful in music. They did make a large acquisition there. Could you see them make an acquisition as it relates to TV and video streaming?
Yeah, I mean, when you kind of look at Apple historically, it hasn't been in their DNA, right? I mean, the biggest acquisition they've made in the past has been Beats for $3 billion. So, they're not really in the business of making huge deals. But that being said, we do think that this has the potential to be very different for them. We think, clearly they are looking to inflect their business more towards services. And, there's probably no better way to do it than to really kind of go out there and look for some attractive M&A opportunity. And to be honest with you, we're looking at a company with more than $200 billion in cash. We're looking at a market that's really kind of seeing a nice correction out there. I wouldn't necessarily be surprised if they're kind of out there actually exploring opportunities. But that being said, I'd say the most likely scenario at this point is they probably just significantly increase their CapEx dollars to kind of capture as much content as they possibly can, and maybe potentially look at some smaller, more nimble acquisitions that they can kind of bolt onto their platform.
Staying with you, Angelo, so different generations will use different devices for video streaming. You've done quite a bit of work on 5G wireless. What kind of impact could it have here?
Yeah, I mean, in terms of 5G, it's clearly not going to have the impact that 4G had. I mean, 4G is an absolute game changer for the likes of Netflix as well as other streaming plays out there. I mean, it really allowed streaming to become a reality on the mobile side of things. But what we do think 5G can help do is continue to accelerate the shift towards cord cutting. I mean, there are going to be more and more consumers that are going to be able to more easily, cut the cord. And you kind of look at some of the offerings that Tuna highlighted earlier. I mean, you couple that with just a better experience with 5G, whether it be ultra high definition, among other aspects of it. And I think kind of you just continue to see that acceleration towards individuals cutting the cord.
Tuna, last question for you. So all the growth is lines that are going straight up, but also helping investors understand the business model. When do you reach scale and profitability for these providers?
That's a great question, because right now a lot of new entrants are operating at significant losses. No surprise when they're literally spending $1 billion, several billions in content and marketing. We think that the most successful players are probably going to need anywhere from 4 to 5 years to kind of scale, kind of get to break even. As you saw from one of the slides I put up, there are no guarantees, and we already seen a lot of casualties, which will continue. So this is not a game for the faint of heart. That's why I think deep-pocketed players that can continue to fund content investments at huge losses that can be absorbed by other profitable areas stand the most chance of kind of staying in this for the long haul. So right now, investors are kind of attuned to the fact that this is going to be a marathon, not a sprint, and it's going to be huge pressures on margins for just about all of the companies that are in the space over the next several years. So it could take quite some time to get up to scale. In the meantime, with potential casualties along the way.
Great. We're on the hour, so let me finish up with closing remarks. Let's move on to the next slide. So join us for the next webinars. April 7th, we have the CFRA Investment Outlook. Should investors keep calm and carry on? With Sam Stovall, Stu Glickman on energy, distressed sector, Todd Rosenbluth. April 16th, understand the growing demand for thematic ETFs. Of course, visit MarketScope Advisor, and below you can go both for the webinars and MarketScope to these two websites. Next. So in these trying times of the coronavirus, COVID-19, we do have a special offer for individual investors to certainly take advantage of CFRA's insights from our analysts and strategists to remain focused on the markets and the latest market developments. and exploring ways in which we can help society and also individual investors, we are offering a complimentary 90-day access to CFRA's weekly online investment newsletter, well known. It's called The Outlook, and this is for North America-based retail investors. We think this is a terrific way to provide individual investors with a exposure to our research, especially to navigate the financial turbulence we're seeing in the markets. Included with this offer are content sets listed on the right, if you can take a look here. And we also want to give to get started complimentary access by using the link below here, which is advisor.marketscope.com, number Outlook 90. So definitely a great weekly product to get a summary of all the research we do on depth and quality that leads to our top ranking in terms of performance. So with that, thank you for taking your time in being with us with Tuna and Angelo on video streaming. Again, have a great day and be safe and healthy out there. Thank you.